The finance minister has announced a few proposals which were being sought after. The rates under the simplified tax regime have been further amended this year, which will result in savings of 17,500 rupees. However, the basic exemption limit remains at 3 lakhs, and the highest income slab also remains unchanged at 15 lakhs. Another expectation revolved around deduction for employer contribution to NPS. Presently, government employees can avail deduction up to 14% of salary, while for the private sector, it stands at 10%. The budget proposes to bring in parity between government and private sector employees by increasing this rate from the current 10% to 14% of salary. There is also a marginal relief for the salary class in the form of enhanced standard deduction at 75,000 rupees. One must, however, remember that all of these are available only under the simplified tax regime, which is also the default regime now. Salaried employees can additionally declare taxes collected to their employer for consideration at the withholding stage, in addition to details of other income and taxes deducted. Now, there are also some proposals on the capital gains front, though these present a mixed bag. The increase in the threshold for long-term capital gains on listed securities by 25,000 rupees is a welcome move, though the expectation was for a higher number. However, the rate of tax has been increased from 10 to 12.5%. Short-term gains on such securities would also attract a higher tax rate of 20%. Now, these would increase the cash outflow for those trading in the market. Long-term gains on other assets would attract a lower tax rate of 12.5% against 20% now. The benefit of indexation has, however, been removed for this category. So the impact of the changes would have to be determined on a case-to-case basis, depending on the volume of transactions, the quantum of gains or losses, etc.